Are you ready to take your first steps towards financial freedom by investing in property? Maybe you've started your portfolio but need some help continuing to grow. Lachlan Vidler and the team at Atlas Property Group are here to help. As experts in property investment, Lachlan and his team are ready to help you take advantage of some of the best investing conditions in almost 20 years. By completing the research, sourcing and negotiations, Lachlan goes the extra mile to find you a high-performing investment and set you on your path to financial freedom. Book in your free discovery call today at atlaspropertygroup.com.au.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant here, host of the Smart Property Investment Show. Hope you're well. Welcome to 2022. You might have heard that a couple of times now. We've been recording right through summer on the Smart Property Investment Show, making sure that irrespective of where you are, where you're sitting, what you're doing, plenty of episodes coming downstream, helping you navigate property investment as we kickstart this year and what a year it'll be. Identified, no doubt, for those of you who are interested in it, federal election this year. People I'm chatting to who seem to know what they're talking about down in Canberra. I reckon it's going to be a May election. We'll see a budget in March. What the budget will say and do, I reckon, is going to be an election budget. You probably heard that beforehand. And I think property will probably show its face somewhere inside the budget, but I don't think it's going to be too contentious. And as we gear up for the election, I think irrespective of where you sit on the political spectrum, there'll be some tinkering with property, but it won't be huge. I think the big focus is going to be around ongoing economic growth, prosperity, connectivity, and putting the right policies in place to make sure that happens. As we kickstart 2022, we don't need to talk about the spike in COVID. You're very familiar with it, no doubt. What it means for property markets, who knows? I think we can hopefully give some sense of that today. Everyone who has been investing in property over 2021 has probably got a bit of a smile on their face. All the numbers have now come out, well, largely of growth, and from CoreLogic in particular, 20+% in most markets right across Australia. But just be careful. That's a catch-all. So some markets have performed exceptionally well. Some markets have performed less well. I was just looking at some numbers before coming on air. Apartments in Melbourne were lucky to get a couple of percent growth last year. And then you looked at some regional areas that got 40+% growth. So this is really just an aggregate balancing out of all those different numbers in different areas, in different states and capitals and all that sort of stuff. Markets move differently. And that's going to be a big theme for 2022. There's going to be some markets that will continue to fire. Same again in 2023. You would have seen a lot of information coming out from the banks at the moment talking about subdued growth in 2022 and negative growth. That means probably prices going backwards in 2023. Let's remember they're from bank economic forecasters, and some of them got it so wrong at the start of the COVID pandemic. They were calling 40% reduction in properties. So just be careful, make your own assessment, make your own judgments, and always invest well within your means. But as we kick off 2022, I really wanted to get into some key themes for this year. What's going to happen, the way we're seeing the world. That's me, Phil Tarrant, host of the Smart Property Investment Show. My job is to actually get information from other people, which I'm pretty good at doing. But I sometimes have an opinion myself as a property investor and someone who does have skin in the game and is buying property all the time. So lots going on there as well. So make sure you keep connected with the Smart Property Investment Portfolio. Heaps of work going on this behind the scenes. As I spoke beforehand, if you've been tuning in, a big process right now, refinancing the portfolio, getting some sharper rates. And I'm leaning on our good friends over at Finny Mortgages to help me to do that. That's finny.com.au. Go and check out what those guys are doing. They're going to be the engine behind the refinancing of this Smart Property Investment Portfolio. Anyway, joining me in the studio to talk through themes for 2022, what's going on in property, the 5 themes that you need to be aware of and use potentially to help shape your attitude and aptitude towards property investing in 2022. Paul Glossop is Director of Pure Property Investment. Paul, how you going? How was the break?
Mate, it's still breaking, but mate, it was a good one. It was a good one. I'll tell you, it was almost as good as your laborious introduction there, Philip. I think you, my friend, you're probably a couple of piccolo short of your morning pep talk. I think a bit longer than normal there. Yeah, let's put ourselves on 1.5 speed, I reckon. Or maybe it's because I'm used to listening to the Smart Property Investment Show podcast on 1.5 speed on my app, that I'm used to talking fast. And it's probably my problem because I talk a bit too fast. And I think you talk probably at the right pace, but I speed everything up, and maybe that's my
So you're
problem.
saying I was talking slowly and I was boring?
Well, look, I didn't say that. I just said you need a couple of extra piccolos.
Well, I'm happy to report that I started my day with an espresso. Then I had 2 large coffees after that. Then I went for a swim and did my daily exercise.
It doesn't sound half bad.
And then I went and had 2 more coffees. And then I recorded another podcast. Now I'm chatting to you. So if I sound boring or mundane or mediocre,
that's a redacted statement from my end.
Probably as a result of the person I'm chatting to, and I'm not channeling any energy or whatnot from you. But this is a classically trained voice, Paul. I don't know if you know that.
No, it's dulcet.
It's gone through lots of expensive work to make sure I speak at the right speed. Try not to use too many.
Spend half that money on the Chevy Chase, then maybe other than just the voice. Well, you and me both have got the little Santa Claus beards going on.
Yeah, I know. I've got to. Well, I'm sort of officially on holidays, but I'm still recording podcasts. So
no, I get it.
That's what we do. Got to make sure of it. 2022.
Well, it's getting to that time. It is getting to that time that we usually talk pretty in depth this time of year every year, it seems like, and we go through, where are we at and sort of assess what's happening. Because it's funny, the December and January times usually come out with a whole bunch of sometimes white noise, but we take up a lot of information, because I do find that a lot of our clients, a lot of people who do digest property investment information take a bit of time to sort of do that full 180 or 270 or 360 sort of process this time of year. And there's a hell of a lot of information out there, and it doesn't move as fast, I find, than the normal media cycle. So it's quite an interesting time. But I've listened to a lot of what you've said recently, mate, and I think we're in for pretty much another very, very good year for Australian property.
It gives some sense for why property, or how property is something which is the very sort of heartbeat of this nation. You work in property, so therefore you do it for a living, and people probably they pay you to help them do property stuff. And anyone that knows me knows I sort of operate in and around property as a humble, mediocre journalist. So they always ask me what's going on. But everywhere there's property information. You pick up your phone or a paper, whatever, there's property stuff everywhere. Some pretty good property commentators out there, myself included. There's also some pretty average commentators out there, but everywhere you go, there's a property story. And I read the Daily Mail. I put my hand up, but also read the Daily Telegraph. I also read the Sydney Morning Herald, and I read the Financial Review. I have a pretty good spread of media that I consume, but I read the Daily Mail normally when I'm sitting on the couch watching some sort of TV show I'm not really interested in. And there's always a property story on it. And it'll be someone's made $1 bazillion overnight, or this person's done this, or this person's done that, or this commentator. The commentators come out of the woodwork on that. And you read this stuff and you just go, it's all fatiguing. It's white noise, to your point. It's white noise. A lot of white noise around property, and people are probably going, well, yeah, you're included, Phil, in that, because you just ramble on around property all the time. But everyone's got different conflicting views. And if you want to go and find information to confirm a view that you have, guess what? You're going to go and find it. And that's the market we're in right now. There are still people out there knocking out off the plan, high-rise apartments in capital cities right across Australia, saying this is the best investment you're going to have. And if you're looking for that information, guess what? You're going to go and find it. If you want to go and buy in regional and rural areas right now, guess what? There's information that says that's a good idea. If you want to go and buy into fringe areas of your CBDs in your more mortgage belt working class suburbs, guess what? You're going to go and find out they're the great reasons to invest, and that's why you should be investing in there. So in summary, if you want to invest in property, you're going to be able to find some information that endorses your opinion and endorses your strategy around it. That's good, but it's also very bad, isn't it?
Yeah, absolutely, mate. And I think that we've spoken about confirmation bias so much over the years, you and I, and I think, unfortunately, and we're all habitual creatures, human beings in general, and regardless, and you mentioned how many coffees you've drank this morning, I dare say that they're probably from a relatively regular place. And if I came in and said, hey, mate, I had an awesome coffee just a couple of cafes down from where you get, I'm like, I'm not interested. I get the coffee where I get the coffee. That's the best coffee. But unfortunately, it is what it is, because we've developed those habits for so many times, and we obviously perpetuate that from our knowledge of where we get information from property information, whether it's friends, family, parents, and everyone else around that circle. And it takes a lot to break it. And to your point, there's people out there who have made money in every different sphere that you've got that you can buy property in. Now, that doesn't mean that off the plan high rises are always going to be bad investments. However, when you talk about, what do we always look for when we're recommending assets, when we're looking at areas or what to invest in, what to probably avoid, it just comes down to a game of averages. And, we're in the middle of Australian summer right now, where we've got the test matches underway, and I was about to see the pink ball Hobart test underway for the first time, which is quite cool. I'm a bit of a cricket buff myself. And talking about games of averages, property for me, I love the analogy of property being a game of singles. And I really look at that in itself is where I look at to say, that if you get bat to ball and you put into a relatively consistent area and you run one run, that's all you need to do 100 times to get 100 runs, as opposed to saying, well, that's a bit short, I'm going to try and hook it over the fence because I can get there a lot quicker, i.e. buying something that's a bit more speculative, whether it's high-rise apartments, a dual key in the middle of somewhere that you've never heard of just because it's recommended to you and it's got a very nice family booklet that comes with it. And I think that's for me where I like to start to think about this white noise and confirmation bias.
No, it's a good point. Is property a test match or is it a big bash?
Mate, that's it. I think that's it. And for me, it's always going to be and always has been. For those who have made money over the long term, it is a test match. For anyone who has made money in the last 2 years, depending on when they started, they will think, and there will 100% be the relics of people who have gone too hard because they thought this game was far too easy, because ultimately every ball's come up at 80 Ks an hour, chest high, and they're just hoiking over the fence because it's very, very easy. But it's for me, if you're in property to make what most are is a passive income through to retirement in some way, shape or form, it's a game of singles and it's a war of attrition. And
to put it that, and I don't mind analogies and sort of playing around with it. The big bash is a lot more brute strength, whereas test matches are a lot more tactical and analytical. But if I was going to frame, this is a good article, if I was going to frame property investment as cricket, I would say it's more about when you actually enter the market. So if you're 20 years old, you get to play a test match. You get to work for as long as you want. You've essentially got 4 decades of making money.
Absolutely.
In order to invest in property. You're the opener.
You got time.
You got time.
Yeah.
If you start investing in your 50s, it's big bash, right? You've got a short period of time to make the runs, and you've got to apply very different applications to making that happen. Whereas that if you're a test match investor, you get to take your time. Yes, there is a time constraint. Yes, you can declare if you've made your runs and you want to sort of step out and let someone else play the game, but it gives you time in order to do it. But you need to be a lot more technically proficient to be able to think about long-term changes, shaping, structures, all this sort of stuff. So it's not a bad way to look at it.
I completely, mate. And it's probably to add my last 2 cents on that analogy is that, and when you've got time, like you're on your quasi holidays, I am too at the moment, and you get time to just sit down and watch a game of sport, which we probably don't get to do very regularly at all. I actually went to the 5th day of the Sydney test with my son, and we sat there for 7 hours and watched the cricket right down to the very, very last ball, which the game ended up being 5 days played and a draw. And it was the most enthralling day 5 of cricket that I've ever watched. And so my son, he was going berserk. But I guess the last point I wanted to make on that, which I know I'm rabbiting on and harping on a bit here, is the fact that ultimately when we get down to this aspect of having the ability to play this game short and what makes probably the most successful test cricketers as far as batters are concerned, is it comes down to that one thing, which typically is patience. The amount of watchers and people leaving a ball that's 4 inches from the top of off stump because they're like, that's just not close enough for me. I'm happy to wait for one that's going to be better because I don't want to give away my wicket.
I'll probably spin this and going on this analogy. I've never thought of it probably this way, but I would say, and property is about attack and defence, and both fielders have that and batters have that. But let's just say the batting pair, the batter is the market, beating stuff around, doing what it does, depending on what's happening. If the property investor is the fielder, you've got the bowler. That's the person largely in control, working out how they're going to play each particular ball. They put the ball down the pitch. That's the property investor. You got wicketkeeper. You got people in the slips. You got people out in deep field. They're your sort of team that go about supporting you, going about doing it. So your wicketkeeper, is your wicketkeeper your accountant, or is your wicketkeeper your broker?
Probably your broker, I think, because he's involved relatively consistently and you can give some pretty immediate feedback. And ideally, you've got a few people along the way every time that ball gets shined as it comes back through the slips and over towards long on, long off. And there's a quick word in the ear saying, well, next one, let's just try to pitch it up a little bit. He's coming forward. We've got to put it up a little bit more. And
I'd agree that's your broker. Yeah. And selling it on's your bias agent, isn't it?
But I think you're silly mid on. Who would that be? That might be your. Let's try to think of him. Is it your building and pest inspector? Is it someone who's there just in case? And
just there for a period of time about the coppeting.
A very short period of time. You only need them, then you want them away.
So I reckon, you know what? I reckon your buyer's agent's probably your first slip, to be honest with you. Yeah. Sitting there orchestrating stuff going, all right, a bit of this, bit of that, you know.
Yeah,
your account's out there as square leg.
Yeah. No, maybe we can rabbit on about these analogies all day, every day. It's maybe that's it. Maybe we need to punch out every sport, every Australian sport, male and female, for analogies for the year.
There you go. Well, there's property investment in cricket for 2022, and I reckon the game died a long time ago when it should just be, my view, it's a red ball game. None of this other hullabaloo. It's 5 days in the beaten sun, no shade, 50 tins of beer. The wave, mate, they've wrecked cricket. I'm going to put it down there. Cricket's been wrecked. I refuse to go to the cricket anymore. You can't be silly at the cricket anymore.
Mate, you can't, but you can figure out, you can be a bit discreet and figure out how to be silly. The Barmy Army's still in their full force now, mate. I'm a sensible man. I drive to the cricket, make sure all of that, and I drive home.
Can you still get a watermelon in there full of vodka? Is that still possible?
Well, I think so. I saw there was footage of someone, they snuck in 2 hip flasks of whatever they had in there in 2 ham and salad sandwiches, where they literally put the hip flask, because there was footage of someone watching them open up their sandwiches. Then they ate the sandwich, and then they had their hip flask of gin or vodka or was a single malt scotch for your sake. That's pretty much what they bring in there.
This is the reason why they don't let me the cricket anymore. I'm the riffraff that they tried at the part. I remember the heyday of the 80s, and the 90s, mainly the 90s, causing trouble. But this is a property podcast, not a cricket podcast.
Get on topic.
But we have had on this podcast Australian cricket players.
Absolutely.
O'Keefe, he was one of the great spin bowlers. Is it client of yours?
He was destined. He's a client of mine. I actually I've actually recorded my own separate little podcast with Steve, ironically, 3 days ago. I saw Steve down at the Big Bash. I think he's playing tonight, actually. Funnily enough, I think they're playing the Sydney Thunder. But mate, talk about a cricketer who's figured out property being a good game. And he's a good friend of mine, Steve. But someone who's coming up to the end of his career now, but has invested heavily throughout his whole cricket career and been very patient and has done extremely well through property by virtue of not hitting sixes. By virtue of literally investing for a 15-year period, eventually developing assets, retained a bunch right across the country, some cash flow, some growth, and there's plenty more of it where he came from in that space.
There you go. Maybe we can get him on back for a chat. He had a chat with us years ago, and that was good. But if you're still playing cricket, where's my free passes? And free passes for me is not in the sunburn section.
Well, mate, he gave me one. We gave me a couple. We were there in Menders, and we came down and said g'day. And mate, you did have an invite from memory, but you didn't reply to my text as per normal.
Anyway,
so
past
mobile.
2022 predictions. What's going on from Paul Glossop? These aren't my predictions. I'm just a guy trying to get by here recording the podcast. Journalist. This guy is the professional pure property investment. We'll go to a break. When we come back, we're going to get into it. Stay with us. Back in a moment.
Looking for a blue chip Gold Coast investment property, or trying to relocate to the beautiful sunny Gold Coast but keep missing out on the right properties? Maybe you need an expert on the ground to source the right property for you. The Srama Group are the leading recommended buyers agency specific to the Gold Coast, providing their clients with exclusive off-market property opportunities, specific insights into market, combined with a large network of dedicated professionals to ensure you make the right decision without the hassle. Get in touch with us at thesramagroup.com.au and secure your financial freedom today.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show with Paul Glossop from Pure Property Investment, talking through what 2022 means. And this is probably about the 50th list of property predictions you've seen. But this is the one that you need to know because it's raw and it's authentic and it's uncut, and it's from a couple of blokes who've invested in property, and then one of them also does it for a living through property. But how is Pure Property going, mate? You guys busy?
Mate, last year was probably twice as busy as we've ever been, and I think this year's probably going to be another, possibly, I wouldn't say twice as busy because I just simply wouldn't be able to cope. But I think it's going to be if not more busy than previously. So we've expanded, and we don't want to expand too much as a business at Pure Property because unfortunately when you grow, you lose quality over time. And one thing we've been very cautious of is making sure that every single team member in our business invests in property. And that's something that's easy to say, but hard to achieve, is people who genuinely want to be in property and work in a company that all they do is invest in property, and from a very young age.
Yeah, how does it work? Like, so if someone wants to do stuff with you guys, do they sort of book an appointment with you or someone else? Or
they typically will speak to me directly. So if they just call our office on purepropertyinvestment.com, you can grab our number there and grab email addresses. Literally, I'd book in. There's either a calendar automatic booking, or they can call our office, email our office, and they set up a time with me. And from that, the initial call is intended to go through warts and all of where we are, where we want to get to. And then from there, typically comes a number of recommendations. And if we're ready to go, then we start going. And that's pretty much the way that we work.
Okay, cool. And my recommendation, and
here we go.
I don't give advice. Well, it's like buyer's agent's good, right? Like, I don't use you as a buyer's agent, but I have a buyer's agent. I've been very happy, and I've been very, I think, vocal around the benefits of buyer's agents. My long-term view, and I'll put it out there, and I think we sort of spoke about it, maybe it was with you or someone else, you're going to see a lot more buyer's agents in the market. 100%. I think if you fast forward 20, 30, 40 years in Australia, there's going to be buyer's agents involved in a lot of the transactions that are taking place. They're going to be talking about where we are right now, going, this was the birth of this industry. I don't know what the percentage yet of how many properties are touched or somehow influenced or impacted by a buyer's agent. It's still quite small. That's going to grow significantly move in time. Irrespective of that, if you're going to use a buyer's agent, before you do anything, go and sort your finance out, because the first thing they're going to ask you is, are you finance ready? And you're going to go, no. They're going to tell you to go and get finance ready. So do that. And if you're a property investor, I spoke about it before, finny.com.au, those guys specialize in investing in property. They do my mortgages. I believe in these guys so much that I invested in this business. It's cool. They do what they do really well. Go and speak to those guys first, or some other mortgage broker. If you want to go closer to home, it doesn't matter. Be finance ready before you do anything, and before you even think about doing anything in 2022 when it comes to property. Point number one, Paul. Predictions, themes for 2022. It's going to be a big delay in the supply of new properties, and it's going to be harder to renovate properties. So anything where a tradie, a builder, or anyone's got to put their hand on it, it's going to take longer and it's going to be more expensive.
Absolutely, mate. And this is one where you can say, look, you typically in previous boom cycles, you'll see certain states, and then those states, certain cities that typically go through these issues over time when you've got grants, new home grants, builder grants, stamp duty exemptions, etc. But we went through the very unique circumstances over the last 18 months where pretty much every state and territory had a grant for new homes, for whether it was first home buyers, whether it was for other aspects of the whole investment space, owner occupiers, etc. Coupling that, which obviously sent demand through the roof, coupling that with supply chain issues and COVID, and now COVID being the big issue with regards to Omicron, being that it's wiping what the data came across at the moment is about 10% of the existing workforce is currently unable to work. And that potentially is predicted to say if school doesn't go back the way it should, then it can go out to 15%. Then all of a sudden you've got 10% less people working for the foreseeable future on a regular basis. And I can attest to this personally. I've got the best part of $50 million in developments underway in my own separate development company, which is 6 different sites across a range of different areas. I reckon we're probably tracking about 50% behind time on where we should be tracking. And that started about probably the first project that we've kicked off in this tranche of developments probably started about 20 months ago. And we've probably got what we expected was another 12 months of developments underway, which is probably going to push out to the end of 2023 now. And it's through no fault of my builders, no fault of finance, no fault of architects, no fault of town planners, as much as I can say councils usually have an issue in that. There has been a few faults of theirs, but I can't say that that's unusual. It all comes down to availability of actual humans to be on site and do what their trained and professionals are doing, and coupling that with everything from basic timber to the nuts and bolts, the screws, door handles, things that are imported. All these things are delayed. And then second to that, they become anywhere between probably 10 and up to 50% more expensive, depending on what material we're talking about, which is going to feed into existing assets.
Yeah. So there's 2 negative levers with that. If you're on your side of the fence or you're doing that type of stuff, number one is that stuff's more expensive. Well, there's 3 levers. Stuff's more expensive in terms of the actual goods. Number 2, things take longer. Therefore, you got to pay more salaries, more expensive. And number 3, there's a really important lever around the timing of completion of these properties as a result of those things. So it may be a good thing that it takes longer because markets may shift and you may see an uplift, or it might be a bad thing is that when these things come for completion, valuations don't stack up. When they come to completion, property values have gone south and you don't make as much money out of it. So they're the negative impacts with that. The positive impacts of that sort of stuff is that there's flight towards more established dwellings. So if you don't want to mess around with that stuff, if you don't want to roll the dice on developing, you don't want to roll the dice on having to do renos, if you want something which is done and you don't need to do anything to it, they can be more attractive to investors, right?
Yeah, absolutely, mate. And I think we spoke about this, I think it might have been late last year, Phil, where you've recently bought a property which literally is brand new and was a labour of love for a number of years from the person, unfortunately, who's built it and for their virtue couldn't hold it. And you know full well that if you went to go and start the process of building what you bought now, A, you probably wouldn't even entertain it because you just know you don't have time, B, the involvement and the time that it takes to build it. It was 3 years, I think, what you've told me to build the property as it is. And I'd suggest that's probably even more now. That would blow out to maybe 4 or 5 year development. And I can attest to it. I've just bought a home, which we actually settle on next week. And we toiled, do we even sell this property immediately? Because we're going to do a full renovation of this house. And we're going back and forth with our architects and our builder at the moment, knowing A, how much it's going to cost and B, how long it's going to take. And we're just unsure as to, do we want to go through 12 months of pain and suffering where we just buy an established property, which may not be exactly how we want it, but these are the questions that I'm even asking as a professional in the industry, looking at this stuff all day, every day, and the same as you.
Yeah, big question mark, to that same thing, to get the materials to build a property like that, probably 50% more expensive than what they were a couple of years ago. And who knows, there's still so much uncertainty around supply chain. And when you think about the depth of supply chains as a property investor, it's considerable. It's considerable, and it can be disrupted for a whole bunch of different reasons. It could be disrupted because logistics companies don't have enough drivers to drive the stuff around to put it on site. It can be disrupted because it can't be sourced from a particular country of origin. I don't know how many different sort of suppliers are involved in the building of a house or how many different types of fixtures and fittings are involved, but it would run into the thousands.
Well, unequivocally, I know when we have our detailed spec list of when we're going through an actual not just a contract sale, but when we go through a specifications list that we specify, and we specify literally the colour of hinges, the colour of screws in developments that we do. So down to that really nitty-gritty fine detail. The document's typically about a 250-page document. So you've literally got a booklet which tells you what the brand is, what the item line number is, what the colour is, what the price should be, who the suppliers are. And you can imagine, I mean, you go back to even taking this out of the equation, the bushfires of 2019, they took into the equation. So that ruined us being able to access timber locally. There's all these things. I mean, it's
supply chain disruption. It is a huge headache. And the thing that you think wouldn't impact can often most impact. If you're waiting for one specific item, you can grind to a halt. So you're going to see a theme for 2022. I think investors should be keeping an eye towards established properties. Yes, if you're sort of, been at it for a little while and you want to dabble in development, do it, but go in all eyes open because it will be a challenge moving forward. And we just don't know what's going to happen with this current virus strain that we have. And guess what? There's probably another one around the corner as well. So get used to disruption. Point number 2, themes for 2022, Paul, and these are your points, but I do agree with you on this specific one. Rents will rise, which no doubt is good news for property investors.
It is good news for property investors, and obviously, quite obviously, the opposite for any of those people who are priced out of buying a home and are just simply going to be sitting on the sidelines. The reality is it's quite simple. It feeds into what we we're just speaking about, is that as much as there is a lot of incentive out there for new builds and development was getting spurred on probably the best part of 12, 18 months ago, that's starting to dry up. So all the grants and all of the opportunities for people to build new and finance applications typically is a very good indicator, early indicator as to what's going to come to the market. We're seeing that has probably halved to where it peaked about 12 months ago. So you couple that with the fact that supply chains are disrupted, that labour is disrupted, and the ability for new property to come to market. Ultimately, we've now got immigration back on. We're now seeing laxes in where I think it might have been Canada very recently, as of, I think, yesterday, Quebec has basically said that they're opening up their channels to be able to open up immigration to any registered nurses to any country in the world who can fall into their nursing system because they have an enormous shortfall. So you've got to think that all of a sudden, all these different opportunities are going to fall back into Australia, where we've got the floodgates open for students, for migrants, and already for the issues that we've got with supply now. I think that we're going to see this being probably will end up with the end of 2022 with the tightest national vacancy rates that we might have ever seen, which is always going to put pressure on rents upwards. And I can give an example anecdotally. I recently were finishing off a development in Sydney at the moment, and the rents that we're doing on our projections on the rents we sold to, kept to of this development, the 4 houses, the rents that we were doing our projections on went from $1,500 a week on the projections that we had, which is a high price rent for a house in Sydney. One of the properties is currently on the market for $2,500 a week. And this is in the space of 20 months. And it's not just because we're asking a ridiculous number. That is the market. So the market has gone up almost, let's call it, it's obviously $1,000 a week difference in 20 months.
Yeah.
It's
and that's without, no one's really, we haven't had any new Australians coming here for 2 years. There's no students, there's no nothing. So to your point around the impact on rents, and the borders are open now, but it's still a bit hard to get here. It's just not open for all and sundry. But when it does open up, and you'll see this as we navigate 2022, and this will be a focus from the government, is skilled migration. Australia's going to be out there looking for punters to come out here to support the growth of the nation. And I would argue most people are going to go to Australia. I'm going to choose where I want to go. Is it Australia or Canada or the US or New Zealand? I reckon most people are going to want to come out here and or New Zealand.
Agreed.
Watch it take place. So that's all good news for property investors. Probably not such good news for those people who are renting properties, but not all rents will rise. I think you're still going to see it pretty slow inside of big, high-density capital city unit markets. It's going to probably lag at a different speed to houses. A lot more people now wanting a bit more space around them. If you are investing in houses, you probably should see a spike in rents moving forward, some more than others, and the different states and different capitals will move at different rates. But this sort of connects in with point number 3 as well. Rents in regional markets should see a spike as well. We're going to another break, Paul. When we come back, we'll get into these next 3 points around themes of 2022. Back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back. Phil Tarrant, Smart Property Investment with Paul Glossop from Pure Property Investment. Point number 3, Paul, and I sort of touched on it briefly before the break, and this is my point, and I think you probably echo similar sentiments to it. Think outside the capital cities for 2022 and beyond. And there's a lot of reasons around it. I've seen some good commentary coming out around growth in regional and rural markets. I've got my own sort of application to this. That doesn't mean you should be flocking out to the back of Burke to invest in regional and rural in Australia. You still need to be very targeted in where you are investing. But my thesis with this is that regional and rural areas on city fringes or within striking distance of capital cities are going to see a big surge over 2022 and into future years as well, despite the fact that some economic forecasters are talking about negative growth in 2023. I think some of these really smart regional rural markets are going to fire along. So don't put all your eggs in one basket, i.e. the capital cities.
Mate, completely. And I think, this is morphing its way from probably what was a bit unknown territory, uncharted waters, 24 months ago when we started to see this great migration away from needing to be in a large office if you worked in corporate, and people were thinking they could go and work remotely, which now is probably becoming more and more entrenched. There's a hybrid model that's probably going to wash its way through all this. And ironically, you brought this point up, but we literally just put out a top 30 report via purepropertyinvestment.com's website. So if you jump onto purepropertyinvestment.com, I think you go to free guides and training. There's a top 30 report you can download there. That top 30 report we put together is essentially a collection of areas which we would suggest will probably do well if you're looking at a tight budget of between 250 grand to probably 500 grand. And I'd suggest that out of those, it's not all houses, there's a combination of different property types, but more than half of those locations are most certainly not major capital cities. And we're confident now that some of the data supporting some areas outside of what is the much more traditional major city markets. And I think the fact of the matter is, to your point, if you can get within probably a 1.5, 2 hour proximity to whether it's airports, hospitals, universities, all in sundry of the things, plus a couple of decent school catchments, the basics that you want as far as decent healthcare locally, decent grocery stores, and somewhat of an attractive climate and a community, you're going to see those markets have already done well, but aren't going to fall off a cliff. And again, I can speak to a large development we're doing up the coast, just in Lismore at the moment, which is a market that's done about 40% in the last 12 months capital growth and has seen about close to 18% rental growth in a single year. And I can attest to that there is a massive shortage of supply in these areas. And this is the irony about a lot of regional markets as well, is that as much as there's a lot more space, you typically find that councils aren't necessarily that pro-development, because you have a NIMBY situation going on with a lot of the locals, because they like the way that life was. They liked it a quieter single dimension sort of, I don't want to see the hustle and bustle. So you have a lot more of that sitting there. So you have restrictions on supply coming to those markets. And that's going to keep the pressure on rents as well as prices.
Well, I think there's going to be a lag between buying intent for people within regional and rural Australia and then the attitudes of your local governments to support growth and development. And to your point there, everyone's complaining about, oh, you can't rent a house in Byron Bay anymore. It's wrecked the fabric of the community around there. It used to be such a nice joint. Now it's wrecked because all the rich people are there. All the people that used to call Byron Bay home has had to move out because they can't afford it anymore. You're going to see more and more of this. The smart councils will have a really comfortable relationship with supporting economic growth through attracting different type of people to these industries looking for more lifestyle, but also keeping the character, the inherent character of these suburbs, which attract those people there. Exactly. So I get it, but this is as old as life. There's time of people complaining around, they hate development. No, we want to leave it exactly how it is right now. Well, guess what?
Gentrification 101. Gentrification,
but go and have a look in America. And do yourself a favour, Google size of American cities, and there'll be a Wikipedia page on this, right? You put Sydney and Melbourne inside of America, by memory, they're both top 10.
Top five
cities.
10, I think they're top five.
Top five. At least top 10 cities in terms of size. These are big cities, right? San Francisco, you think, wow, San Francisco, it's a small city. Like it's not a big place, but that's deemed to be a big city. So in America, you see they've really embraced this idea of regional and rural areas becoming sort of satellites within themselves, and they operate outside of, little rings around it. So you're going to see that emerging in Australia. These regional and rural sort of capitals, and you talk about Lismore, you've got Casino, you've got Coffs Harbour, you've got Port Macquarie, you've got those sort of areas further north up New South Wales. They're going to become bigger places. They're going to have their own CBDs. They already do right now, but they're going to build, and they're going to have these sort of satellites out there. Then you look towards my thesis around striking distance to capitals. That's still a fair way away. You're not, if you're living up that way,
2 hours to Brizzy, but you still got, you got things like you got regional airports, you got access to Ballina, you got 45 minutes from the coast, and then you brought up Byron Bay, and Byron Bay is an impossibly expensive market. It's very, very much close to some of the premium markets in the Sydney, Melbourne, Brisbane, Perth, Adelaide areas, Hobart, etc. But you go away from the coast, and then you're seeing areas like Lismore, you're seeing areas like Mellamimby, you go further up towards a bit in from Ballina. As much as they're not cheap, they're far from cheap, but they're good areas. And this is it. Like, people aren't moving into literally one pub towns. They're moving into areas which have a really nice community. There's a lot of people in there who have money, have double incomes, and are actually happy to set up life there. So I think we will see this. And this is going to be generational, because ultimately when people do settle, and then they have the family, and then they have the next generation. That next generation grows up in that regional town. And this is how we're going to see these regionals. I mean, for so long, we feel like they've been crying out that they want to see people migrate there. They want to see more talent. How do we attract talent in these places? And, this is all of a sudden just throwing the spanner into it straight away. And all of a sudden, these places have got more people than they can care to know what to do with.
Yeah, and you've got to remember also is that you're going to have renters, you're going to have owner-occupiers in all these different areas. Now, as these areas, and called Ballina or Byron, this area you're talking about, it's going to be attracting those people who buy the big fancy houses in those areas, right? However, with that becomes the surge of the local economy and everything that's associated with it, which requires jobs, right? So there's going to be people who are renting in those areas. So for property investors, you might not be able to sort of be blowing millions of dollars on a house up in these more regional areas at that end, but there's layers of property which are really good from an investable point of view, and they're the stuff you need to be looking at.
Absolutely, mate. Absolutely. It's funny. I've got a client. Speaking about Byron Bay, I've got a client who runs. I'll give him a plug if you don't mind. People probably aren't using it. I think it's called Go See Kayaking, Byron Bay. Anyway, the guy's been running a kayaking business out of Byron Bay for 20 years. So literally has a raft of kayaks. People come for a holiday, and he drives out there. He's got 20 kayaks, takes them out. Round the past.
So would he be considered a local? Has he been there
100% local,
yeah,
born and bred. And this is it. So this is where I look at the polls of what people's opinions are of someone who's seen these. I think he's mid-40s. He might actually listen to the show, I think. So he'll get a kick out of this. But this is someone who embraces the fact that Byron Bay is, by and large, it has been a tourist town. It has its own economy now, but it has been, and it's built its way out of being a very affluent area and a beautiful area and tourist town. But you've got someone like that who runs a business that obviously booms when the market booms. As far as people come in, they flood it. And he has held a property there for 20 years. That property's done really well, but he's also taken that money that's come from his business and reinvested it elsewhere. And I think he's got a portfolio of 5-8 properties now, some commercial, some resi, and saying he's got a development site. But you speak to someone like that on the other side of the equation, they're like, well, this has been the best thing that could have happened to my life. And not only that, he employs 10 people, some of it seasonal. And this is what happens as those markets build. You hire more and more people, and more people get attracted to that area. So I think this is the way it should work, is that people enjoy the area, but they get a lot more out of it because it helps the locals in those areas as well. And it's not all just people coming in, having a week of times at the pub and eating out and then go home. They essentially mean more employment, and more employment means people do better.
Absolutely. Anyway, so that's a big trend moving forward. So challenge your own mindset and attitudes towards it. I know a lot of investors, and I probably bundled myself up into this a few years ago where I went, if it's not capital city, I'm not interested. But the world has changed, and the change has been absolutely accelerated by COVID-19, where it was going to go anyway. The internet in these areas is now as good as the city. And I think that was a thing that was really slowing it down probably 10 years ago. The way we communicate and connect now is completely changed, leveraging online collaboration tools. So see a lot of it moving forward. Point number 4, and this is important, it's around money. Accessing finance will remain challenging. However, we may see cheaper mortgages for a little bit longer than some of the information that was sort of coming out last part of 2021, Paul.
And I think we spoke off air about this bit, and we speak very regularly. Obviously, being involved in a finance company, this is a very, very important component of what we need to understand, where the recommendations come, how do we structure finance, and obviously you and I being property investors, and you're going through a big refinance at the moment. These are always big considerations, and when you've got big portfolios and big numbers floating around, small decisions can have huge impacts on numbers and cash flow. But I think the difference between where we were probably mid last year, when we were all sitting midway through a lockdown and probably thinking, okay, once this lockdown's done, we're going to see some pretty clear sky and we know that we're going to get back to normality. And now all of a sudden realizing that, hey, look, this can strike again, and it can keep striking again and again. I think the bullishness of where we expected everything to go from it, and remembering that the support in the economy that was there last year and the year before is non-existent now. So those who can't trade are making $0. There is basically minimal to no incentive available now. So I think it's a very different algorithm that people are doing their math on. Hence why I think it's going to have a larger impact on the economy, and why we're sort of opening the floodgates to different visa holders, etc. But I do think that as long as inflation itself doesn't get to the point of being completely and utterly out of control, which I think in turn will also probably keep itself in check because of the fact that we're seeing these issues that we're seeing right now. What we were sort of starting to read about, having 1, possibly 2 interest rate hikes towards the end of this year, start of 2023, might be postponed a little. And if it doesn't, it probably won't be as aggressive as back-to-back sort of quarter-on-quarter interest rate hikes. And I think wherever we end up, we're not going to end up that much past probably 0.5 to 1% higher at the end of this interest rate hike rate or this cycle. But I personally think that we're probably talking more now somewhere in the 2023s to 2024 as and when that plays out there. And you mentioned at the start of this podcast, mate, that election year is also a bit of pressure on the RBA to say, look, keep things a bit muted as far as keeping money and the price of money increase, and keep that out of the media for as long as you possibly can, please, because we want to win an election. So I dare say that we probably won't hear as much about it this year, at least for the first 3 or 4 months, that we probably did all of last year.
And, chatting with people, senior people in government who know about this stuff late last year, and in my discussions with them, they were pretty much saying you know what, the market's sort of already priced in interest rate rises for 2022, like as a fait accompli, it's going to happen. Now, that was before this current strain of the virus took hold. You're going to know things are different when the banks start coming out, revising their positions from late last year on this around rate hikes. That's when you're going to know there's a trigger, something's going on. Now, I don't think the RBA and the government are going to do too much with the interest rates for the moment until they actually understand the impact of this current strain. You know, you're talking 10, 15% of the workforce taken out at any given time as a result of this virus. Yes, they've relaxed a lot of the conditions now around close contacts and all this sort of stuff, right, to keep the economy moving, particularly around those essential workers, whether logistics people, hospitality people, right? That all sort of makes sense. But there's going to be a delay, I think, before any sort of significant monetary policy changes. They're talking about this current sort of spike in the virus, and they think sort of of a week
ago, later this month,
like 90,000 people a day. In New South Wales, like that. That's a big number, right? So they're talking about a peak of the virus happening soon, and then it's going to be coming down. Who knows what's going to be happening there? But there's a lot of anxiety out there right at the moment. But I'm already seeing a lot of the anxiety dissipate around it. People want to get out there doing stuff. They're conscious of the virus, and concerned about how they're going to move forward. So. Should they not move as fast to change the rate setting on the official cash rate? Now, remember, you have the official cash rate. That's what the Reserve Bank says the interest rate is. And then you've got the actual interest rate that the banks tell you it is. And the banks will move that irrespective of what the RBA does, particularly fixed rates and stuff. If the cost of money changes for them, they're going to get a hike in it, right? So things are going to move anyway. But if there is a lag in interest rates, or even if there's a lag in the rhetoric around interest rates rising, as in it is generally a 2024, which is what they were talking about, they being the government, RBA, in the middle of last year. Does that mean that will change this attitude towards more subdued price growth over 2022? So is 2022 going to be as big as 2021? That's what I'm getting at, price growth.
Yeah, and I think that this is where that correlation comes in, because when we see the downward trending money rates, then we typically see that correlates to increase in prices. Once you start to see the price cycle start to increase, then that's when you start to see that longer term. It's a pretty simple correlation of saying prices start to subdue, or they probably don't grow as fast. And in some cases, if you get restrictions on access to money, then they can go backwards. What I've seen, and you've probably seen the same thing, Phil, in the last probably 6 to 8 weeks, is you're starting to seeing probably slightly more bullish predictions of 2022 now as far as price growth, where only 3 or 4 months ago, we're probably starting to say that this is the last year of growth and expect to see pretty much flat, if not maybe slight growth in the majors. I'm starting to see now a lot more rhetoric around expectations around anywhere between 6 and 12%, depending on which capital city you're talking about, and these are the same economists, same banks that were probably talking 0 to 4% only 3 or 4 months ago. And I think they're realizing that access to money is going to stay relatively good, because they don't want to tinker with that. APRA handbrakes, changes to any access to funding. I don't think they're going to talk about that at least till after the election. But I think as Omicron's playing out, for me, that's probably the other big thing too, is that those same predictions, the same forecasters who work with the bank are probably seeing now that the headwinds are there to start to increase monetary policy. Therefore, money's going to stay cheaper and more accessible for longer, which typically only ever helps the property investment market and the property market in general.
Absolutely. So remember, property's a game of finance. Get your finance sorted out before you do anything. Point number 5, Paul, our last point for 2022 themes, areas of challenge yourself maybe for this particular year. Capital cities aren't just Sydney and Melbourne. So if you want to invest in capitals, we spoke about sort of regional rural economies and potential for investing in those areas. But if you're a diehard capital city property investor, there's other places than Sydney and Melbourne. And mainly what we're going to be talking about there in terms of growth, I would say absolutely Queensland, Brizzy, but Hobart, I'm hearing pretty good things about.
We've spoken about this as long as this podcast has been running, I think, is that as much as we personally, and I personally invest and have invested a long time in Sydney and also in Melbourne over the years, and so have you, Phil, and so have many of your both probably guests as far as investors, and a lot of buyers agents, other buyers agents you speak to do have times that they work in Sydney. There are always going to be other markets. And we've begrudgingly spoken about Brisbane a lot over the last probably 4 or 5 years, investing there heavily. You have, I know, I've worked in that market quite some time between 2015 and basically now, is that it's been okay. It's been a relatively tempered pace, but it is most certainly, and I think I said it in this podcast 3 months ago, that Brisbane will be the number 1 performing city in Australia in 2022, hands down. Actually, I think, you know what, it was on a podcast with you, me and Tom Panos, and he said, what's some of those headliners? And I think
that's right. Yeah, that was Real Estate Exposed live stream I did with Tom Panos.
Yeah. And I think that was the time we said, look, all the signs are pointing to that market being number one. But that being said, you brought up Hobart. Hobart, actually, on paper, when you look at growth and also yield combined, Hobart was the number one performer in 2021, number one out of any capital city in Australia. And, you know, going back to, I know we were buying in Hobart a lot between 2015, 2016, 2017, and a little bit in Launceston, Devonport, Burnie. Those are markets that looked very attractive back then, still look somewhat attractive now, but I think I'm probably seeing better value in other markets. But when you look at markets outside of that, markets such as Canberra done very, very well in the last 24 months.
It's easy with Hobart. It's easy to move the needle when you have very small comparative stock movements, right?
Correct. And yields have been good, though. Supply has been tight, and that will stay the way. Yields have obviously been compressed, but rents have still grown. But if you look at places like Brisbane and Adelaide has come out of the gates roaring in the last 6 months as well. And that's another market.
Well, they call it Radelaide, Paul.
Radelaide. They only call it Radelaide when it is Radelaide, and I think at the moment it is Radelaide.
Well, I'll tell you what, it's definitely Bris Vegas coming forward, right?
And
roll the dice up there, go for it.
Absolutely. And I think, to a lesser extent, Perth has been that sleeper for a very long time. And again, going back to a depressed market, a very depressed market, it was sitting 2 years ago. And that's a market that is on the up and up.
Just sorry to digress, but this is probably the most important point of this whole podcast. You got Radelaide, that means it's a cool joint. You got Bris Vegas, that's cool. What's Sydney? What's Sydney or Melbourne or Hobart? There's no nicknames, is there?
There isn't. You're stitching me up here for something to make my non-creative mind come to a catchphrase.
Melbourne's got to be something like Doldrum.
I know there's I use Get Out of Townsville. I know that one.
Maybe that's what we need to do. We need a top 20 list of the top names of colloquial property investment locations. And if you know that, write it in write us some contact the team. If anyone knows what Sydney is and what Melbourne is,
absolutely,
what Hobart is, what's I don't know what Perth is, or Darwin. I need to know these names. I need them.
I think the locals will be able to give you something there. They'll probably come up with the what they perceive as the not so favourable suburbs in there, and they probably have some fun colloquialisms around them, no doubt. Yeah. But mate, I think we'll be talking a lot more about markets outside of Sydney and Melbourne this year, and probably for the next 2 or 3 years. And Sydney, for the obvious reasons that it's had exponential growth and where prices are sitting now. I don't think Sydney is in a position where we're saying it's bubbled and it's deflating. I definitely don't think we're there. The evidence is pretty clear in the clearance rate data and the growth data. Melbourne hasn't had the same growth over the last 2 years cycle, but in saying that, it has most certainly seen a lot more of the issues around what has been jobs creation as well as population. There's been a mass exodus. And realistically, it doesn't look like it's probably in the best position to recover out of any of the major markets across Australia at this stage. And I think that's going to be a bit more of a fundamental issue with Melbourne for some time to come. And rents, if you look at actual rental yields, it's sitting as the lowest rental yield city in Australia at the moment, which I don't think is going to change for some time either.
Well, I think that's probably the frame of reference to the 2 years that Melbourne's had. I think it's he gets picked on by the rest of Australia now. Even in, I don't know if you've seen it yet, the new Lamb ad for Stray Day, they pick on Melbourne. They frame them as like pasty, weak little people sort of are really fragile. So maybe that's a
you know what though, I'll tell you this, Phil. There. Yeah. and it comes back.
Go and look at the Lamb ad, by the way. You know,
well, I was going to say it ties into the Lamb ad with no doubt a bit of Sam Kekovich and everyone else that goes around there, because they typically have got some very good marketing campaigns around it. But going back to what we were talking about right at the start and talking about some sporting analogies in the game of singles, is that you do have to then come back to yourself. And I know we're talking about what's going to happen this year, but going back to the fundamentals of why you're investing in property. You're investing in property for 2022, or you're investing in property for 2032, for 2042, for 2052. And then you've got to say, well, which markets have provided that fundamental expectation of real simple, predictable growth that combines itself with cash flow? And, if I do defend Melbourne at all, I defend it on its long-term position that it's provided over the last 30 years. And it has been the number one performing market over the last 30 years if you look at compounded capital growth. However, I dare say that when we look at where the data sits, if you then look at it in about mid-2020, so 2025-ish, I dare say we'll be looking at some other major capital cities which would overtake it because the cycles don't play out the same way. And that's the interesting part about property, is that as much as we're talking about 2022, we always have to temper this with saying, just put together what you're wanting out of this purchase. Or is this the first? Is this the fifth? Are you buying this for cash flow? Are you buying this for growth? Are you buying this to develop? And put that all into those combinations.
Good counsel. Thanks, Paul. Long podcast, but anyway, let's kick off 2022. There's 5 key themes to help shape, frame investing in 2022. Some of them are always there. Some of them are going to be unique to this particular year. Who knows? Lots going on, lots of moving parts. One thing you need to accept for 2022 is there will be ongoing disruption. One thing you need to accept for 2022 is that there's a whole bunch of stuff that's outside of your control. So make sure that you got your stuff sorted out so you can control what you can control as effectively as possible. That's Paul Glossop, director? Pure Property Investment? Yeah, right.
Pure Property Investment.
You go and check these guys out. I think they've got some space in their calendar. What's your website again?
You just said it. .com.
Oh, is
Pure
it?
Property Investment.
There you go. Right. So it's pretty simple. Favour for me, please. And Paul, I know that no one who I know in your team who all listen to this particular podcast, because this is what actually turns into good.
Check it, Phil. I'm going to stop you there. Check it.
Are they all given a review?
All provided reviews. 5-star.
Right. 5 stars. Okay, fair enough. Well, tell everyone. There you go. What's your client's name up in Byron? What's his business called?
Go See Kayaking.
They Go See Kayaking. Okay. Right. He can leave a review then.
Absolutely. Absolutely will.
Yeah,
he's got a few properties around those different areas as well. But he deserves you to give a couple and tell his friends to give you a review as well, even if they don't listen to the podcast.
You can do that wherever you listen to this particular podcast. Yeah. Anyway, we drag and digress. Hey, if you want to come and have a chat on the show, editor at smartpropertyinvestment.com.au, come and have a yarn, whether you got 1 property or 50 properties, doesn't matter. Everyone's got a good story to tell. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Looking to refinance your loan for a better rate? Maybe you're considering releasing equity to grow your portfolio or struggling to find a lender that can meet your needs. Finny is the investment finance specialist that has the solution. With access to over 70 lenders, Finny can track down the financing solution you need. We specialize in investment property finance, and we only deal with lenders that have the right solutions for investors just like you. So you're in safe hands. Fast-track your investment strategy today. Visit finny.com.au for more information.